Hi, everybody. I hope you are well. Welcome to this webinar surrounding stablecoins, the Genius Act, and risk prevention approaches for the blockchain analytics part of it as well, which we'll be more than happy to walk you through. But very, very nice to see all of you joining. Just making sure that we have some of the people here. Perfect. Yeah, so we have two sections, as you can probably see. One section will just be the chat, where you can basically just jump in and say, give any comments. The other section will be the Q&A chat, where you can ask any questions. We'll display them on the screen, and we'll be more than happy to answer them as we go through. I'll give it 1 or 2 more minutes before we actually start with the introductions, what this webinar will look like, what we're going to talk about, who am I, who's Justin. We'll briefly introduce ourselves shortly, but I already see. Okay, so some people are saying the chat is disabled. Thanks for letting us know. So maybe Chandan, yep.
I think it's going to be in the Q&A to ask questions, but I could be wrong on that.
Yeah. No, the Q&A definitely.
Okay.
Alvaro, yeah, so we are not enabling the chat, so we are just keeping it Q&A, yeah. So people can ask any questions under Q&A section.
Okay, got it. Yeah, that's totally fine. So you can ask any questions in the Q&A then. Thanks for letting us know, Swati. I don't know if I'm mispronouncing it, but thanks for the heads up. Appreciate that. I think we can maybe start introducing ourselves. So, once again, welcome everybody. My name is Alvaro. I'm here with Justin as well. We'll be talking today about the Genius Act and overall, risk prevention strategies, blockchain analytics around stablecoins as well. So I will just quickly, introduce myself, and then Justin, of course, you can introduce yourself and take over. But so I'm directing operations at Merkle Science, which is a blockchain analytics company in charge of wallet screening, transaction monitoring, investigations in the blockchain, and everything that has to do with ecosystem safety, that has to do with on-chain activity, let's say. So yeah, my background is in investigations. I worked at Europol in the European Police and crypto crime investigations in the past. I worked in Chainalysis. I'm sure a lot of you are aware about Chainalysis tool, also in investigations, trainings, etc. And yeah, now I'm currently working at Merkle Science. So very, very nice to meet you all. I'll be more than happy to share my insights and experience throughout the webinar, and more than happy to answer any questions that pertain to my domain of expertise, let's say. I think maybe Justin, you can introduce yourself.
Sure. Thanks, Alvaro. And hi, everyone. My name's Justin Levine. I'm a counsel at Davis Polk. I'm a financial regulatory lawyer. I focus now basically almost all of my time on digital asset regulatory issues, in particular, doing a lot of work on stablecoins. I've been advising on the legislative developments over the past few years for various clients that have been watching it unfold in the US, and advising both current stablecoin issuers and other fintechs or crypto natives, and also some traditional financial institutions and large banks, particularly after enactment of the Genius Act, that are exploring the space either to issue stablecoins or offer complementary services. I'm also on the advisory board of Stablecoin Standard, which is a international trade group, industry body of stablecoin issuers and other crypto firms advocating for consistent and clear rules of the road across various jurisdictions. So thanks very much for having me, Alvaro. Nice to meet everyone. So the way we're gonna do this presentation, I'm gonna take the first half and just take the very simple task of explain what is the Genius Act, what does it say, what are the requirements. And I say that jokingly because there's a lot to unpack. And we're just in the midst now of implementing rules, which I'll get into, and I'll discuss some of the rule making proposals that are coming underway to further fill in the gaps and the details of the Genius Act. Happy to take questions throughout. You'll see I'm going to share slides that have a lot of text on them. I'm not going to just be reading from the slides, but capture some of the key points. And I believe the slides will be shared afterwards. So don't feel the need to read through everything. You'll have that as a reference afterwards. So now to start, I will share my screen.
Yep, and while you're at it, just to remind everybody, please feel free to to ask questions. I will be going through your questions, and we'll be interacting with Justin as he's explaining, obviously without too harshly interrupting his flow of the presentation. But any questions will definitely be addressed. So any doubts, questions, you can always ask in the chat. And yeah, over to you, Justin.
Great. So can you see my the cover slide?
Yes, we can see it.
Okay. Okay, so to start off, just a level set, the Genius Act was enacted over this summer. It's not effective yet. So it was enacted by Congress, signed by the president. But it will be the effective date of the act is the earlier of 18 months later. So that's early January 2027, or 120 days after any final rules are implemented. So we're in the midst of proposed rules. We don't yet have any final rules. It seems that the regulators are directed to issue the vast majority of the rules within 1 year of enactment, and they're hard at work at proposing those rules. So it seems that it will become effective 120 days after that. That will probably be the trigger rather than the January 2027 outside date. That's relevant for various provisions, and I'll talk about how there's the interplay of the timing. It leads to some complexity of issuers or potential issuers that want to issue a stablecoin under the Act. The Act includes federal preemption of state licensing requirements, but it's important to keep in mind that those preemption and such don't actually kick in until the effective date. And just to set in where we are, as I said, the FDIC and the OCC, two of the three main federal banking agencies, have each proposed rules. The FDIC's proposed rules limited just to the application procedure, whereas the OCC has issued a very comprehensive proposal, close to 400 pages, a few weeks ago, that covers essentially everything in the OCC's remit under the Act. The U.S. Treasury, which handles various aspects of the bill that we'll get into, including a lot of the illicit finance controls, has requested comment and done an advance notice of proposed rulemaking. Those are essentially earlier stages ahead of a proposed rule, but has not yet issued any proposed rules. And neither has the Federal Reserve, which is the other main federal banking agency that has authority and jurisdiction under the Act. So as I said, we'll dive into what the Genius Act says. I'll layer in with some of the proposals to date, focusing in particular on the OCC, the Office of the Comptroller of the Currencies proposals, just because those have been the most comprehensive to date. But I'll note where there are other ones as well. And there's an appendix to the slides that I'll be sharing that lists out all the reports and rules that are required to be issued under the Act. It's several dozen. It's quite comprehensive, and you'll see that of the various rules, who would be issuing them, in the timeline. And that's in an appendix in case people are interested. So to start, I'd like to start with just a few of the key definitions. And then after that, I'll discuss the different categories for permitted payment stablecoin issuers and who the regulator is. I think that will set up a nice foundation for the way the Genius Act works. And then I'll get into various aspects of the bill and various requirements. So to start, the definition of a payment stablecoin, it's here on the slide. the way I think of a payment stablecoin is that middle bullet, so the issuer of which, and those two subprongs, is essentially two promises that a stablecoin issuer makes that causes a coin to be a payment stablecoin. One, the issuer is obligated to redeem the coin for a fixed amount of value. And two, they represent that they'll maintain stable value. They represent that the coin will maintain a stable value because there is a reserve of assets backing that coin that they promise. And these two promises really combine, and they're interrelated, which is you have the reserve and you promise to use assets from the reserve to redeem a coin at par. One thing to note is the definition of a payment stablecoin under the Genius Act is not limited only to stablecoins that back the US dollar. In the market today, I think US dollar-backed stablecoins represent 99% of stablecoins, but the act is broader and could capture other stablecoins as well, denominated in other currencies. But if you look at this definition, it does not capture, say, algorithmic or other decentralized stablecoins that don't have an issuer, don't have a set pool of fiat assets backing it. So there are other types of stablecoins that are not subject to the bill. Another important aspect of the bill is the definition of distributed ledger. So the way there's a series of defined terms. A payment stablecoin is a type of digital asset under the bill, and a digital asset is defined as a type of asset on a distributed ledger. The definition of distributed ledger refers to a public distributed ledger. And in my mind, there's a little bit of ambiguity of whether that is limited to only what we view as like public permissionless blockchains, or whether permissioned blockchains could still fall within the definition of a public distributed ledger within the meaning of the act. The import there is if a certain blockchain doesn't qualify as a distributed ledger as defined in the act, the assets on that blockchain technically would not be payment stablecoins and therefore would not be subject to the Genius Act. The OCC, which, as I said, has issued a proposed rule, it also includes over 200 questions for the public to comment on, raises this point as a question. It raises the point of what should the OCC in implementing regulations further define a distributed ledger to clarify this point. So I think that will be something that will remain to be seen and play out. The other point I'll make on this slide is payment stablecoins are carved out from the definition of security, and also payment stablecoin issuers are carved out from being investment companies under the federal securities laws. And then the act is also clear that payment stablecoins are distinct from tokenized deposits, so tokenized bank deposits. And the act does not address tokenized deposits. Those are explicitly out of scope of the bill. The last set of definitions that I want to briefly touch on before getting into further parts of the bill are the OCC's proposal defines affiliate and control. The definition of affiliate is relevant in various aspects of the bill, which I've noted at the bottom of this slide, and I'll discuss a bit as we talk through. What's noteworthy here is the OCC has decided to use the Bank Holding Act definition of affiliate and control, which is an affiliate is any person who controls or is controlled by or under common control of another person. And then the definition of control, for those of you who might be familiar with U.S. bank regulatory requirements under the Bank Holding Company Act, is very broad. The key provision is that third prong, which is the controlling influence test. This is primarily, it is directly interpreted, and there's rules by the Federal Reserve that say you could find control with as little as 5% of voting securities in a company. The OCC says they reserve discretion to interpret the definition, but they expect that they will follow Federal Reserve interpretations. So that's just something to keep in mind. The definition of affiliate at least for the OCC purposes, is broader than the common understanding. It's not based on, say, 50% ownership. It could be as small as 5%. Now I'm going to talk through the different types of issuers and the different types of regulators under the Act. The broad, like an overall comment I have on the Genius Act is it is modeled off bank regulatory requirements, but it is specifically and intentionally tailored and more narrow than the traditional suite of bank regulatory requirements. So I'll just finish this thought, and then I see there's a question in the chat. But the point I want to make is similar to in the US, our dual banking system, which is banks could be regulated primarily at the federal level or the state level. The Genius Act takes that same approach. This slide shows the options for being federally regulated. The next slide, I'll get to state issuers. For federally regulated, there's two broad categories. There is a subsidiary of an insured depository institution. So an IDI is what you typically think of as a bank. Noteworthy that an IDI, a bank itself, can't be a stablecoin issuer, but it would be a subsidiary. That makes sense because if you think of a stablecoin as having its own dedicated pool of reserves, it would be more difficult for a bank, whose just entire balance sheet of its entire liabilities essentially are deposits. It would be more difficult to segregate that. So it's simpler for a subsidiary of an IDI to be the issuer. That's what the Genius Act requires. And there, the primary regulator would be the same regulator of the IDI. So national banks, that's the OCC. State banks that are members of the Federal Reserve System, that's the Federal Reserve. State banks that are not members of the Federal Reserve are FDIC. And then the other category is federal qualified issuer, which are non-banks. So just a normal LLC or corporation, an uninsured national bank. That's quite noteworthy. There are uninsured national bank captures national trust banks, which are essentially a subset of banks that don't accept deposits and are not insured by the FDIC. Therefore, they're not banks for purposes of the Bank Holding Company Act and subject to the wider array of bank regulatory requirements, but they are banks for purposes of the National Bank Act. You might have seen in the news there are a lot in the US of national trust banks that are being chartered, many of which are doing so primarily for stablecoin strategies, either to be a stablecoin issuer directly, or there's various charter applications where an affiliate will be the stablecoin issuer, and the National Trust Bank will custody the reserves, manage the reserves, and provide ancillary services related to their affiliate stablecoin. And then the last category, the federal branch of the foreign bank. All of those are regulated by the OCC. The point to take here is that the OCC has the widest grant of jurisdiction, both for subsidiaries of national banks and then all of the federal qualified issuer categories. That was a point of contention. Other drafts of legislation would have given a lot of the authority to the Federal Reserve. The OCC has essentially come out with having most of the authority. That's also why the OCC's proposed rule is very important, because it will govern a wide aspect of the jurisdiction. The next slide, I'm going to discuss state issue. But before that, Alvaro, it looks like we might have some questions.
Yeah, exactly. Thank you, Justin. Really appreciate it. We have a few. Let's start with the first one by Maria. Thank you for your question, Maria. Really appreciate it. So the question, we will answer it live. So she says, good day. Thank you for the webinar. I have a few questions. In your opinion, when will the relevant legislation to regulate the free use of cryptocurrency in the US actually be adopted? And which specific body will be responsible for regulatory oversight? Will the regulation of cryptocurrency use be carried out at a state level or through federal regulation? Could a federal license, if obtained in the future, exempt one from having to comply with any regulations within a specific state? So this is quite a deep question, but feel free to answer it as much as you can.
Sure. Thanks, Maria. So I assume by your question referring to cryptocurrency more generally, you're talking about the broader array of digital assets and not just stablecoins. So as I said, the Genius Act is limited only to payment stablecoins. Um, Currently in the US, there is a lot of work in Congress for what people refer to as market structure legislation, which would regulate the broader array of digital asset activities, most prominently the trading of digital assets. Um, just to give that could be the subject of another very long webinar as well. Just a high level, what it does is it seeks to regulate and clarify the status of different types of digital assets. So whether they're digital commodities or digital securities, who the primary market regulator would be. So that would be the SEC, the Securities and Exchange Commission for securities, and the CFTC, the Commodities Futures Trading Commission for commodities. And then it would also regulate the offer and sale of digital assets. So even if a digital asset itself is not a security, offering digital assets in capital raising transactions either could be securities transactions or subject to various disclosure requirements or restrictions on insiders resales and such. The bill also has some coverage of illicit finance, Bank Secrecy Act requirements, and also some bank regulatory provisions that would clarify the activities that banks can engage in with respect to various types of digital assets. So it's a much broader piece of legislation. To the specific question of preemption and licensing, it essentially is modeled off existing categories of brokers, dealers, both on the SEC side for securities and commodity derivatives, and would create new registration categories for the digital asset equivalents of those. And there would, like today, there would be varying degrees of preemption in that bill as well.
Perfect. Yeah, and I like that you made that emphasis on the actual stablecoin specifically, as opposed to general cryptocurrencies, which I think also leads us to the aspect of definition and a question we just got from Enrique, saying, is there a difference between tokenized deposits and stablecoins? What is the main difference, and how does that impact regulation?
Yeah, that's a great question. So there's several nuances to the way they differ. A payment stablecoin is fully backed. When I say fully backed, there is a reserve of the full amount backing the stablecoin. So if I hand $1 to a stablecoin issuer, they take that dollar and they put it in a reserve of dollars or other very safe liquid assets like short-term treasuries. And 100%, they don't essentially redeploy that and rehypothecate the reserves. A bank deposit, a tokenized deposit, is just a bank deposit represented on a blockchain. And a bank deposit is not fully backed. That's the whole reason we have a whole structure of bank regulation for the risks inherent in that model of I give $1 to the bank keeps some portion as a capital requirement, but the vast majority is lending out to other customers, stimulating the economy. Another difference is a payment stablecoin is closer to a bearer instrument, where it transacts in secondary market transactions, and we'll get into this, why that's really important. And whoever holds the stablecoin on the blockchain has that stablecoin. A bank deposit is more account-based money. So when you think of your bank deposit, you have a contractual relationship with your bank. You could convert it into fiat, a dollar bill, and then it's a bearer instrument. But when it's just a bank account, it's on the records of your bank, and they say it's yours. You can't lose it. You can't transfer it without the bank knowing, essentially. So those are two kind of differences from bank deposits. Obviously, there are similarities. A lot of the yield debate in the US right now is kind of prompted from these similarities, but there are some differences. And then the next question, how does the Genius Act differ from MiCA? I think that would be a whole broader conversation. I think at the highest level, there's a lot of similarities. I'm less of an expert on Mika, so I don't want to get over my skis, but I would say there are at its core, a token that's meant to be stable, that is fully backed by reserves is very similar. Mika covers a lot of other categories beyond just stablecoins, whereas, as I said, the Genius Act is limited just to stablecoins. And then I'll take maybe one more question and then keep going. On federal qualified, there's a question from Swati on a federal qualified issuer. Does the non-bank entity have to be a U.S. publicly listed company? No, that's a great question. It does not have to be publicly listed, but it does have to be based in the US. And that's an important point. So the permitted payment stablecoin issuers are all domiciled and incorporated in the US. There's a separate category of foreign payment stablecoin issuers that I'll get to. But these are all US incorporated entities, but they don't have to be public companies. Perhaps I'll get started. I'll continue, and then I see there's another. I'll just take the last question. There's one more. Alvaro, do you want to read it? Sorry, I took over your job.
Yeah, no, you're good. You're good. And yeah, I want to make a little bit of emphasis on what you said before about Mika, because I was also specializing in crypto regulations in Europe, and I think indeed Mika has a much broader scope, let's say, covering way more than just generally crypto. It covers general cryptocurrencies, not only stable coins, but also crypto issuers, virtual asset service providers, etc., across 27 EU countries, right? So that's a little bit different than the Genius Act, which is focusing solely on payment stablecoins. But indeed, I'd say the regulatory philosophy is very, very similar, right? So definitely with you on that one. The last question would be, happy Tuesday to you as well. What are the risks of holding a stablecoin as a common man?
So that's a great question. Essentially, the Genius Act at the most fundamental level is designed to minimize those risks. But the primary risk of a stablecoin is you think it is worth, $1, and something happens and it's not worth that dollar. So there have been examples of payment of stablecoins on the secondary market that start trading. It's called breaking the peg and trading below $1. That could be for various reasons. The most obvious is people lose faith that it is fully backed and that the stablecoin issuer will be able to fulfill its obligation to redeem coins when you ask to redeem for that full dollar. The Genius Act, essentially at its most fundamental level, is designed to mitigate that risk, to have strict requirements on what backs the coins, on reporting of the reserves, of supervision by the regulators, of the requirements of when you redeem and how, to mitigate those risks. But that essentially is the fundamental risk, I would say.
Amazing. I think from here we've answered all questions, Justin. So please feel free to continue.
Great. So as I said, this slide covers the federal option for regulation. The second option is for state issuers. And the construct is issuers can choose to be either regulated primarily at the federal level or the state level. But to go down the state pathway, there's a few conditions, quite important conditions. One is there's generally a cap of 10 billion in outstanding payment stablecoins. So you have to be under that amount, subject to an exception I'll get to go the state route. So it is intended for smaller issuers to start the state route, and larger issuers would be in the federal route. The second key requirement is that the state regulatory regime has to be deemed substantially similar to the federal regime. So the Genius Act only sets the framework for the federal rules, and essentially says, states, you are free to create your own stablecoin regimes, But to qualify within this federal legislation, it has to be substantially similar to the requirements set out in the bill. And it's essentially the requirements that I'm going to discuss on the subsequent slides around like what the reserve assets are, the capital requirements, the reporting requirements, and so on. The framework for determining that is states themselves, the state regulators, would certify to a new body called the Stablecoin Certification Review Committee that they're substantially similar. And then that body, which is composed of the heads of several federal agencies, has the opportunity to object or not. So what you're going to see I've been focused so far on the federal regulators that are working on issuing their rules. What's also happening right now is various state regimes either already have stablecoin regimes or are working to develop them. Will have to work on making sure or refining or creating new regimes that meet the federal standards and are deemed substantially similar to get that certification. The one exception that I noted is from the 10 billion cap is a issuer that starts under 10 billion, later goes above the 10 billion cap, generally would have to transition to federal oversight. But there's a concept of getting a waiver, and there's a presumption that issuers in certain states that already have pre-existing regimes are presumptively approved for that waiver. So there's some nuance to the state versus federal divide, and generally small issuers only being in the state, subject to that exception. I will now go to the next slide, which covers foreign payment stablecoin issuers. So as I said at the outset, permitted payment stablecoin issuers are U.S. companies. And the bill, essentially the central restriction in the Genius Act is you have to be a permitted payment stablecoin issuer to issue a payment stablecoin in the United States. That language is really important, in the United States. The view is that only captures the primary issuance and sale of the stablecoin, not the subsequent trading of the stablecoin. So if I am a foreign issuer, and there's many prominent foreign stablecoin issuers in the market today, I can issue my coin to non-US people outside of the US, and conceivably it could still trade in the US on trading platforms, so the Coinbases of the world. And that coin wasn't issued in the US, but it subsequently trades in the US. If the Genius Act only covered that first part, that would be an obvious loophole. So the Genius Act also says payment stablecoins issued by a foreign issuer cannot be traded on US custodial trading platforms unless either they satisfy a safe harbor or more likely they comply with these 5 conditions that I have on the slide. So a few things I'll note on this. I won't walk through each of those conditions. One, this only applies to trading on custodial, so CeFi trading platforms. It doesn't capture bilateral transactions, just you to me to Alvaro in a MetaMask wallet, or on DeFi, on Uniswap and such. But it does apply to custodial centralized trading platforms. And the rules bite. I have a slide that shows the various types of penalties, and I think it's up to $100,000 a day if you're a central trading platform that is allowing foreign payment stablecoins to trade on your platform that don't meet these requirements. The requirements are comply with seize and freeze requirements. This is primarily an anti-money laundering, countering the financing of terrorism and sanctions requirement. Essentially, the U.S. Treasury can say, we see you, foreign payment stablecoin issuer, your coins are being held by illicit actors or being used for illicit activity. You have to programmatically freeze or prohibit them from further transacting that coin. And the foreign issuer, even though a U.S. company. They're not directly subject to the U.S. Genius Act. If they want their coin to be able to trade on U.S. platforms, they have to submit to that and agree to do that. The other requirements, the next one is comparable regulatory regime. That's somewhat similar to the state, substantially similar requirement I noted, but the expectation is comparable is a slightly looser standard. But we still have to see Treasury and decide which other foreign jurisdictions it deems are comparable. The next one, which I'll touch on a bit, is you still have to register with the OCC, the foreign issuer. And when this came out, I thought to myself, well, that potentially is a really big deal. Originally, I said, a foreign issuer is not directly regulated by the Genius Act as a permitted payment stablecoin issuer. But if you register with the OCC, what does that mean? And the OCC's implementing rule that I discussed does lay that out. And there are some differences, but at generally speaking, the OCC proposes to regulate these foreign issuers quite similarly to the US issuers by virtue of registering with the OCC and the conditions that attach. The last bullet covers some aspects of foreign payment stablecoins. They don't receive as favorable regulatory treatment in the US for accounting purposes, for capital and collateral requirements, and for wholesale payments. That's essentially, I think the balance that's trying to be struck is, the US legislation can't comprehensively regulate the whole world as much as it tries to in certain places. There are some requirements for foreign stablecoins that are trading on US platforms for US persons. Those requirements are actually quite meaningful and gets you quite close to what the US issuers are subject to, but not entirely. And then also US payment stablecoins receive some favorable regulatory treatment.
Maybe we can stop for just a few minutes just to answer a few more questions pertaining to things you just discussed. Then the first question by Tarek says, Dear Justin, what could be the impact of current geopolitical conditions on the implementation of Genius Act? Would the dates differ?
So, no. Geopolitical events are not going to impact the effective date of the act. One, I think the U.S. federal regulators are hard at work already proposing rules, working to finalize rules. And two, even if the rules weren't finalized, as I said, the latest it could become effective under the statute is January 2027. So even if the federal regulators are delayed, it will become effective at the latest January 2027. I mean, geopolitical dynamics are relevant more broadly of just since the enactment of the Genius Act, I think there are various jurisdictions throughout the world that are becoming more focused on stablecoins because of the idea that the Genius Act as legitimizing and creating the ability for greater institutional adoption, and the fact that stablecoins today already 99% are US dollar backed. I think there are a lot of jurisdictions that are concerned that as US dollar backed stablecoins proliferate, it could have impacts for their monetary policy and their currencies. So I think a lot of other jurisdictions are focused on this area, but I don't think it's going to impact the Genius Act, at least in a narrow sense.
Thank you, Justin. Appreciate it. Question from Jennifer. As a non-issuer payment rail regulated under MiCA or MiCA, how does the Genius Act view our pass-through KYC model for indirect US clients?
Great question. And the answer is we don't know yet. There's the OCC's proposed rule. At the very end of my presentation, I have a slide of all the things that have not yet been proposed. The key categories are the rules for the illicit finance rules, so the Bank Secrecy Act, the anti-money laundering, the sanctions compliance. The details have not been filled in yet. And then the other broad category is the comparability determinations and the reciprocity determinations that the U.S. Treasury has to make. The Treasury has solicited some public comment, but it has not even proposed the rules yet. So we don't yet know how those kind of decisions are going to be implemented yet.
Fair point. And we're getting a lot of questions, Justin. So definitely we'll try to just answer maybe one more and then we can continue and then do the rest. So the last question for now, and we can continue, is again from Maria. Thank you, Maria, for the engagement. How then will it be possible to distinguish between fraudulent schemes and legitimate crypto companies, given that there are additional ways to circumvent mandatory regulatory requirements, such as requiring customers to sign a waiver of liability? This is a direct route for various fraudulent schemes perpetrated by scammers.
So US requirements in the Genius Act for stablecoins, but even more generally for all digital assets. I would say general fraud requirements and consumer protection requirements apply to essentially all digital assets, regardless of the type, regardless of whether we know if it's a security or not. Like, there are anti-fraud rules that apply. Merely waiving liability could be relevant in certain bilateral contractual scenarios, but you can't waive away the ability for someone to defraud you. So I would say there are still general supervisory powers available to various regulators. For stablecoins in particular, there is a whole enforcement toolkit for payment stablecoins. And one thing to note is you don't avoid that by simply just avoiding to register, because it's a violation and comes with serious penalties to issue a payment stablecoin in the US without registering. So stablecoins in particular, there's a whole toolkit under this act. But I would say for any digital asset, an NFT, digital asset, digital commodity, fraud is still policed under both at the state and federal level, and there's still tools for that.
Perfect. Thank you, Justin. And guys, there's a lot of questions. It seems, Justin, you've been very popular with your insights. We have a lot of questions. So, I don't want to interrupt the flow too much. There is going to be room for answering remaining questions at the end of the webinar anyhow. And maybe, if Justin progresses through towards the end, we can answer a few more. But I think, Justin, maybe we can continue with your slides.
Okay.
And then continue. Yeah.
Great. So we just discussed foreign issuers. Another important aspect of the bill is non-financial issuers. So this is most prominently like the Meta, the Walmarts of the world, whether these tech companies or e-commerce or other non-financial companies can issue payment stablecoins. The Genius Act essentially sets a very high bar for non-financial companies to be able to become permitted payment stablecoin issuers. You essentially have to have that stablecoin certification review committee, which is composed of the heads of 3 important federal regulators, to allow it to happen under these 3 conditions, finding that there's not a material risk to safety and soundness, data use limitations, and anti-tying requirements. I will say, I think this is intended to be a very high bar that would be very difficult for very large non-financial companies to satisfy. That said, the restriction is very cabined, and there are ways for these non-financial companies to be involved with stablecoins without being subject to this prohibition. One is this requirement only applies to public companies, public US companies. So non-public tech companies, just as a definitional matter, are not subject to the requirement. 2, it applies to the companies as well as subsidiaries or affiliates. And as I said earlier, the definition of affiliate uses the Bank Holding Company Act's definition, which is very broad, but there are ways to avoid being an affiliate. So think of a consortium, so a group of many companies could form a consortium where the consortium's entity itself is the issuer, and by virtue of just being a stablecoin issuer, it is engaged by definition in qualifying financial activities. But if none of the consortium members are deemed to control the consortium, which could be structured using, say, non-voting equity and other structures, they would not be affiliates and they would not be subject to it. So a broader comment I have is I expect there to be a lot of consortiums. I think it makes sense in the stablecoin market for economies of scale, for network effects, to have a lot of companies come together in consortiums. And one thing to watch is non-financial companies can join these consortiums as a way to get into the stablecoin issuance market. I think this is the last hot button topic of my slides, which is the prohibition on yield. You might have been following this. This was very contentious during the negotiation of the Genius Act. It's also coming up now with market structure legislation. Interestingly, one of the key items of disagreement in market structure is yield on stablecoins. The Genius Act, so this snip on the top is the statutory language in the Genius Act, which is worth taking a look at. It is very lawyerly crafted, so I will read it out. It says, no permitted payment stablecoin issuer or foreign issuer shall pay the holder of a payment stablecoin any form of interest or yield, and it's defined broadly, whether in cash, tokens, or other consideration, solely in connection with the holding, use, or retention of such payment stablecoin. A few things I'll note on this definition. One, interest or yield, whether in cash, tokens, or other consideration, is intended to capture you can't just, I'll classify this as a reward or a loyalty program, not interest, therefore it's not subject. This broad language will capture it regardless. But this restriction by its terms only applies to the issuer, whether a permitted payment stablecoin issuer or a foreign issuer, not to third parties, even not to affiliates. And then two, it only applies with respect to holding, use, or retention of a stablecoin. So under this language, I, as an issuer, can't just give a passive yield to the stablecoin holders, but I can pay rewards for other reasons, say distribution services or marketing expenses, or activity-based rewards that are not solely in connection with holding or retaining the stablecoin. The OCC's rule that recently came out seeks to further expand on this prohibition, and they create a rebuttable presumption that extends the statutory restriction to cover certain yield arrangements that involve what I'll call an intermediary, specifically an affiliate or a related third party. And essentially, if the Genius Act statutory language says issuer can't directly pay yield to stablecoin holder solely in connection with holding, the OCC's rebuttable presumption is you can't have an intermediary in the middle, which is issuer pays yield to affiliate or related third party, and then the related third party or affiliate pays to the stablecoin holder solely in connection with holding. That's pretty notable of extending the statutory prohibition in some ways, but not in others. So it extends in that even if it's not directly from the hands of the issuer to the stablecoin holder, it could be captured. But it's not broad in the sense that it's still only solely in connection with holding, using, or retaining the stablecoin. So there's still the ability for activity-based rewards. Those lines are still very blurry. I think a lot of people will comment to the proposed rule asking for clarifications, maybe safe harbors or specific fact patterns of what's captured, what's not captured. And then even just foundationally, what is a related third party? The definition is a bit broad and somewhat circular. So I think there's still quite a bit of uncertainty of what reward programs will be captured and what will not. And then this whole debate is also unfolding at a second level in the market structure legislation, as I mentioned. This is on white label issuance. I'll just say the OCC requests comment on white label issuers. It expresses some skepticism of the risks involved of having one issuer issue coins for various differently branded coins, but solicits comments on the right approach. So I think the final rule will get into more detail on that. Since we're so far along, I think I'm going to move a little quicker on the next section of slides. And then Alvaro, feel free to stop me when you want to cover some more questions.
Don't worry also, Justin. I think from my side, the aspect of we'll be doing a demonstration after of how to monitor stable coins from a compliance perspective, how we're doing that at Merkle Science, etc. But it will not take that much time. We want to really allow Justin to answer some of these questions because I see a lot of you are very interested. So we'll definitely prioritize that. So no worries about the timing aspect. Maybe we can answer 2 or 3 now. Then you can continue. So we have Enrique here. The first question saying, would a stablecoin issued in Puerto Rico be considered foreign payment stablecoin issuer, or the same rules would be applied if this was issued in a US state?
Good question. I'm 90% sure that the definition of permitted payment stablecoin issuer and in the US includes territories. I'd like to double check, but I'm pretty sure that an issuer in Puerto Rico would be deemed a permitted payment stablecoin issuer.
Perfect. Devendran asks, how will crypto exchange platforms outside of the US will be affected when using payment stablecoins? I'm not sure if it's regarding whether the Genius Act would affect them or just overall, but feel free to answer as you will.
So in terms of the Genius Act, not much. So the rules on US custodial platforms that allow trading on foreign stablecoins that I discussed, that only applies to US platforms. It does not cover foreign platforms. So directly, the Genius Act does not cover it. I would say in the sense that those coins, if they are payment stablecoins issued by a permitted payment stablecoin issuer, the coins will be regulated in the US, and the US issuer will be subject to the requirements, which should provide comfort of, having the reserve being maintained, the reporting and such. But the US regulators, at least, will not be directly overseeing its trading on the foreign platforms. That will be subject to the foreign regulatory regimes.
Perfect. Vladimir is asking, why do we need multiple issuers? Wouldn't that increase the risk of failure? Why can't the government simply issue a nationwide stablecoin?
So this gets at an interesting question of who should be allowed to issue payment instruments. A stablecoin issued by the government, people refer to that as a central bank digital currency, a CBDC. There's been a lot of certain people in the US that are skeptical of CBDCs, of the ability of the government to monitor and privacy implications. There are others that do think it's a good idea. I would say the Genius Act doesn't touch that. It just regulates privately issued stablecoins. I would say in the US, the ability for privately created money is not unique. So US dollar bills are obviously minted by the US government and created by the US government, but bank deposits is actually like a form of money created by banks, and banks are very closely regulated, but that's a form of private money that we have today. And then, just Venmo and PayPal and such, like there are lots of private companies that facilitate payment instruments, and there's a view that you want to have some private sector innovation in payments. But the question of whether to also or instead have only a government issued digital asset-backed coin is a policy question that, at least today, the US has decided to come out with a bill for privately issued payment stablecoins, but not endorse central bank digital currency.
There are a few questions, we can address them as one regarding the Clarity Act. So basically the questions would be surrounding, what changes do you foresee with payment stablecoins if the Clarity Act is passed outside of the stablecoin yield reward issue?
So one specific example, and I'll go back on my slides if I can. So as I note in the footnote here, so there's two different versions of the Clarity Act circulating right now, which is confusing. There's the version in the House of Representatives that passed the whole House last summer that would actually further modify this restriction on non-financial issuers to tighten the restrictions to essentially to cover private companies as well as public, and also to make it more difficult for non-financial companies to be part of a consortium. The Senate version that is the focus of debate now, also called the Clarity Act, would not do that. The Senate version would not amend the Genius Act at all, at least as currently proposed. So directly, nothing would change under the Genius Act outside of the yield discussion. The Clarity Act in the Senate is focused on yield paid by third parties, specifically was referred to as digital asset service providers, so like the trading platforms. More generally, I think market structure that governs, regulates the trading platforms and the intermediaries, so the the digital commodity brokers, the digital commodity dealers, the digital commodity exchanges, will be facilitating trading in payment stablecoins, and that bill will govern those intermediaries, but it doesn't directly impact the way stablecoins are issued or the requirements of issuers.
Thank you, Justin. I think we can continue from here, and then I'll jump in shortly when there's more questions.
Okay. So this slide covers the application process. I'll just say the Genius Act sets strict criteria on what a regulator can consider in approving or denying an application. It's intended to limit the discretion and make it a narrow inquiry. Also, it sets tight deadlines of 120 days to review a substantially complete application. And if a regulator doesn't issue a decision within 120 days, it's deemed approved. That's meant to put pressure on the regulators to review and decide on applications quickly. The state regime, as I said, has to be substantially similar, but the states are free to make their own application requirements. The FDIC, in its proposed rule, it's limited to the application process. The FDIC is not even proposing a formal application form. It proposes a letter application where an applicant essentially writes a letter describing how they meet these 5 criteria that the FDIC would evaluate. So it's meant to be less onerous than traditional bank regulatory applications that cover a lot more criteria. The regulators have a bit more discretion and historically have taken longer to review and approve. This slide covers in more detail the OCC's proposed rule implementing the Act. The one point I'll note here is the OCC had discretion to include additional criteria for evaluating applications, but declined to do so. It limited to just the statutory criteria. This slide covers the reserve requirements, which is one of the most important aspects of the bill. So as I said, the defining feature of a payment stablecoin is it is 100% backed by high quality and highly liquid, safe assets. So the eligible assets are listed here. Generally, you could think of them as cash, bank deposits, and very short-term treasuries, as well as money market funds that hold those assets, so cash deposits and short-term treasuries, tokenized versions of those eligible assets, and then there's a general catch-all for similarly liquid federal government issued assets. Note that's government issued, so not privately issued things. So you wouldn't be able to have, privately issued bonds be in a stablecoin reserve or commercial paper, but there's some discretion for the regulators to include, say, like treasury, inflation protected treasuries, or perhaps slightly longer term treasuries. Disclosure requirements, the issuers have to report monthly the reserves. They have to be examined by an auditor. The CEO and CFO have to certify to the accuracy of the reserves and could face criminal penalties for knowing violations. As I noted before, there's a general prohibition on rehypothecating the reserves. So that means, unlike a traditional bank, I can't have my reserve assets and lend them out to earn additional income. All I could do is collect the interest that accrues from those reserve assets. And then redemption, the act just requires timely redemption without further defining it. The OCC's proposed rule defines timely as 2 business days. One other part that I'll raise on redemption is there's a requirement to redeem within 2 business days, but that's only for stablecoin holders that have contractual privity with the issuer that go through their onboarding requirements. So today, most stablecoins, a very small percentage of people actually mint or redeem the coin directly with the issuer. Typically, you would trade it on secondary market platforms or with intermediaries that might issue or redeem directly with the issuer. This slide details the OCC's proposal to fill in the details of the reserve requirements. It proposes 2 options for people to comment on. The first is a general principle-based approach that the reserves are sufficiently diverse and manage credit, liquidity, interest rate risk with an optional safe harbor. The second option would be to take that safe harbor with the specific requirements in the right column and make it a hard requirement. This is actually quite interesting, and I'm not sure how many people expected the OCC to go this far. So the Genius Act just says what eligible reserve assets are and has a general grant to the regulators to issue implementing rules saying what portion, so like X% are composed of treasuries, X% are composed of deposits. The OCC is proposing at least one option, which would be quite prescriptive of how you could allocate between the different reserves assets. I won't get into the details right now, but you could see the specific requirements of 10% are composed of insured deposits. There's a 30% requirement of 40%. The OCC refers to this as certain daily liquidity requirements, weekly liquidity requirements. And then the last part I'll flag is the weighted average maturity of the entire reserve portfolio has to be no more than 20 days. So cash deposits, bank deposits have a maturity of 0 because they're demand deposits you redeem instantly. But as I noted, you could have treasuries with a maturity up to 93 days, at least under the Genius Act. But under the OCC's proposed rule, the weighted average maturity of all of your reserve assets would be no more than 20 days. This slide discusses aspects of access to the federal banking system, things that general banks are subject to. One, stablecoins are not subject to deposit insurance. The policy decision is essentially there's not need for deposit insurance because stablecoins should not exhibit the same risks as traditional bank deposits do because they are fully reserved by high quality safe assets. And then 2, access to master accounts. This is accounts directly with the Federal Reserve to have direct access to the federal payment system has been a hotly contested issue. The Genius Act neither expands nor contracts eligibility for a master account. I will say, though, that one category of eligible issuer, which is the non-bank, the uninsured national bank, are under existing law eligible for master accounts. And there are national trust banks that are applying to be a payment stablecoin issuer and also to have access to a master account. So that will be an interesting thing to see how it unfolds, whether the Federal Reserve grants those applications. As I said at the outset, the stablecoin issuers are generally subject to a bank-like regulatory framework, but it is tailored for stablecoins. On the next slide, I'll discuss capital requirements. We touched a bit on liquidity by virtue of the reserve diversification requirements. The activity limits is also important. The Genius Act says a stablecoin issuer, the issuer entity, generally can only engage in a narrow set of activities of issuing and redeeming the coin, managing the reserves, and custodying reserves and the stablecoins. But then it also says any other activities that are directly related to those activities, and then also gives the federal banking agencies discretion to also allow an issuer to engage in a wider array of digital asset service provider activities. So like facilitating trading of other digital assets. So the OCC has discretion whether to allow those additional activities if they're authorized under existing law. Otherwise, stablecoin issuers, though, are generally subject to that narrow list of activities. But unlike general bank regulatory requirements that impose activities restrictions on the entire corporate family, these requirements only apply to the issuer itself, not affiliates. So a stablecoin issuer could have an affiliate that engages in any other category of activities. Stablecoin holders are also given priority in insolvency. The idea is if a stablecoin issuer goes bankrupt, its general creditors should not be able to get access to the stablecoin reserves. The reserve should be held only for the benefit of stablecoin holders. Similar to a bank, if a bank goes bankrupt, banks actually don't use the bankruptcy code. There's a special receivership regime and resolution regime, but it's intended to keep bank depositors have priority. Similar concepts for stablecoins, which is important and should help promote the confidence in a stablecoin that you are not last in line in the bankruptcy process. Obviously, though, there are still difficulties. So if a stablecoin, a stablecoin issuer has not yet ever gone bankrupt and gone through the bankruptcy process. So there's still uncertainties of how it will play out. But this is meant to at least provide them with priority. There are also various consumer protections in the bill. One I'll note is misleading advertising. You can't advertise a payment stablecoin as if it was an insured deposit or another instrument. You have to make it clear it is a payment stablecoin. The OCC's proposing rule proposes capital requirements as well as an operational backstop, which will be relevant. The OCC is proposing a tailored capital for each issuer based on their business plan and their projected revenues and expenses that they would provide in their application, subject to a minimum of 5 million. And it would be composed, and the OCC is proposing is only tier 1 common equity and additional tier 1 instruments. The other point I'll make on this slide is, in addition to the capital requirement, the OCC is proposing an operational backstop of 12 months of expenses, which would be updated on a going forward basis. So as an issuer is chartered, they would have their general capital requirement and then would also have to maintain 12 months of operating expenses composed of highly liquid assets. And every quarter, it would take a rolling average of its expenses that it would have to maintain, with subject to pretty significant consequences if it does not maintain those capital and operational backstop thresholds.
Let's just stop for a minute there. for some of the remaining questions. We have Emmanuel here asking, many thanks for the opportunity. So thank you as well for joining. How multi-issuance model stablecoins, more than one issuer of the same stablecoin, one of which is established outside the US, are treated? That is the question.
That's another great question. And I suspect that this question is being generated because MiCA requires, as I understand it, for stablecoins issued to EU persons to be issued by an EU entity. So today in the market, there are issuers that issue a stablecoin with dual issuers. So one legal entity in the US that issues the coin to US persons, and I think everyone outside of the EU, and then a co-issuer formed in the EU that issues the coin in the EU. I would say this is also one of the key uncertainties that remains to be seen how the regulators will handle this. I think there's going to have to be essentially like a memorandum of understanding between the US regulators and the EU regulators and any other jurisdiction that also requires such a dual issuance structure. Because there's going to be questions of like, how do you know the reserve assets are in the right jurisdiction and tied to the right component of the coin? So the short answer is neither the Genius Act nor the OCC's rules yet directly address this. I think this is going to be something that the Treasury, US Treasury, will deal with in its rules.
Next question by Edward. For issuers under $10 billion, do states have to adopt all of the federal requirements to qualify as meeting Genius standards? And if so, is it possible some states may be too slow to adopt this into their law before January 2027?
Yeah, so this is another one where the standard is the state regime has to be substantially similar to the federal regime. Obviously, that's a somewhat broad concept. What constitutes substantially similar? As I said, the Stablecoin Certification Review Committee is the one that's going to be making those determinations. They are directed to issue an interpretive rule clarifying the criteria they will use to determine what is substantially similar. That has not yet been proposed. So that's another key rule that has to come out. In terms of states and whether they will be deemed substantially similar in time of the Genius Act's effectiveness, that's another open question whether they will. I mean, one thing to note is states are not required to do so. So I don't expect all 50 states are going to create regimes specific for the Genius Act. I think will be some of the larger states that already have guidance and that have been more digital asset focused, and some others. The ones like New York in particular already has a well-developed digital asset and stablecoin guidance and rules, like with its bit license requirements. California also has a statute that's coming online this summer. I think they will be some of the forerunners of looking to create regimes, but I don't think all will, and certainly not all will be in place in time. So that whole timing aspect of, oh, I want to be a state issuer in X state, if it's not ready yet, you kind of can't take that path.
Yeah. We have another from Ryan. How does the European MiCA regulation differ from current US law? I think we explained it a little bit in terms of scope. But then the follow-up is the US system a single national framework or a division of authority between various state and federal regulators? Genius Act provides clarity on stablecoins, but what about other digital assets like cryptocurrency? So I think it's more of just a bit of definitions there.
Yeah, so Alvarez, you mentioned MiCA, is supranational, and then each of the countries have their own laws. I mean, there's an analogy to the US federalism approach of federal laws and then state laws as well. I think it's somewhat similar, but it's obviously not exactly the same. I will say generally what the Genius Act does, and similar to lots of other areas of laws and financial regulation, is there's regulation at both the federal and state level if you go to the federal level, there is federal preemption for certain aspects. So if you get a federal license in certain areas, that preempts the need for state licenses in certain areas, but not all. So with the Genius Act, what it does is if you get a federal license, you are preempted from the need to get state licenses, both state stablecoin licenses, but also other money transmitter licenses, which will be really important. But the Genius Act expressly does not preempt state consumer protection requirements. So that's the balance that the Genius Act takes. Market structure, it's still unfolding. I think there's generally similar concepts. Market structure is also focused, it's a federal bill on federal registration categories, and there are certain aspects of preemption as well.
Perfect. We have two last questions, both from the same person, so I guess we can, merge them. Maria is asking, according to Genius Act, do they essentially recognize cryptocurrency as a valid alternative means of payment on a par with fiat currency, the US dollar in particular? And do you think cryptocurrency will essentially become a means of payment just like any other recognized fiat currency?
So the Genius Act, one, doesn't touch other assets outside of payment stablecoins at all. In terms of payment stablecoins, no, it does not cause them to be legal tender, but it does legitimize them and create a legal framework for their use. And I think will provide a lot of clarity for institutions to use them in institutional context as a payment instrument, similar to the way that the US dollar itself is used. I had on that earlier slide that foreign payment stablecoins are not treated as certain things. So as cash equivalents for accounting purposes, as eligible collateral for derivatives trades, and then also for wholesale bank payments. It doesn't actually say the converse, that US payment stablecoins are treated those ways, but there's perhaps somewhat of an implication that they should be. And it opens the doors for regulators to say that they will be. So there are US companies that are already issuing policy positions and requesting comment from regulators saying, so for accounting treatment, they should be treated as cash and cash equivalents, which would make them easier just from an accounting and capital perspective to transact in. And I think moving in that direction as within the regulatory perimeter as an acceptable means of payment is going to continue to happen. That doesn't mean they're exactly legal tender, but they will be a recognized means of payment.
Okay, perfect. I think just to finalize, and there's really no more questions, but the last one would be, do you think such requirements by the OCC will restrict competition among smaller market participants, since only large and medium-sized banks will be able to meet the requirements regarding capital levels and the minimum track record of profitable operations?
So I would say this is like a central thing to balance for any type of regulation. You want rules to protect consumers and to create a fair marketplace, but you don't want rules that are so burdensome that only the largest companies can effectively pay to satisfy them. The Genius Act tries to strike that balance by having a more tailored approach compared to general bank regulation. In general, the capital requirements, the application requirements are more narrow and less complex than general bank requirements, but totally fair that, a minimum 5 million capital requirement is still a decent amount of money. And the smallest companies might not be able to, scale to deal with all the requirements. I think that's kind of where the federal versus state construct comes. So I think smaller issuers will still have the opportunity to take state pathways. And by the way, I think, states have to be substantially similar, but they're not all going to be exactly the same. And I think there will be some flexibility among states. So you might see some states tailor to smaller issuers and others tailor to larger issuers. So it's all a balance. I don't think there's a clear answer there, but it's weighing different regulatory considerations.
Yep. Thank you for the insights, Justin. I think from here, you can carry on. Maybe we can wrap it up shortly so we have time a little bit for the demo and then just the final link for the participants to obtain their certification training and answer a few questions there.
Okay, great. I have a bunch more slides, but I don't want to take too much more time. So everyone will get the slides. Maybe I'll just spend a few more minutes just to capture one other area, which is the illicit finance rules and specifically the Bank Secrecy Act rules, the anti-money laundering and sanctions compliance. So I will skip over to those slides. And I'll just cover this relatively briefly, which is to say, the Genius Act says that the permitted payment stablecoin issuers have to do these 5 things, which is maintain an effective AML sanctions compliance program, retain appropriate transaction records, do suspicious activity reports, comply with lawful orders by the government to seize, free, and freeze coins held by illicit actors, and have an effective customer identification program. That's, all significant and well and good, but the Genius Act doesn't say anything about what constitutes an effective compliance program or what exactly do you have to do to meet these standards. That's all going to be in the implementing rules, and that is one of the key categories of rules that have not been issued yet. So those will be issued by Treasury, and specifically FinCEN, which is the Financial Crimes Enforcement Network, which is a department within the U.S. Treasury, that I think will be one of the most important rules to set the more color on the requirements. And in particular, what I note on this, on the second to last bullet is secondary market transactions, because today I think it's pretty clear that the customers that have direct contractual privity with an issuer have to be KYC, they're onboarded. But what are the expectations for an issuer with respect to their coin that's traded among anonymous people on DeFi or just in, on chain and in bilateral transactions? And the analogy is to cash at an ATM I mentioned earlier. Like JP Morgan, I go to the ATM, only if I'm a customer can I pull cash out of the ATM. But no bank then monitors what I do with that cash. I could do whatever I want, buying it, trading with buying it from other people and doing other activities. So that balance of what oversight is going to be required in the secondary market transactions, I think there's going to be some monitoring, but the devil's in the details. And that's where I think there's going to be a lot of demand and need for like blockchain analytic companies. And Alvaro, I think you're going to discuss the tools that Merkle Science has. I think that's going to be like a really important aspect of the regulatory regime for stablecoins. So the next few slides that people can refer to on their own cover some of each of those requirements that I mentioned, and then considerations of what the regulators might do. But essentially, the key point is this all remains to be seen in the implementing rules. Otherwise, I have some slides on the stablecoin ecosystem, preemption, which we discussed. There's some ethics provisions, and then this lists the remaining key outstanding rules. So the reciprocity determinations for foreign issuers, the BSA AML requirements, the substantially similar standard for state issuers, all of those are still forthcoming. So I will stop there and stop sharing my slides.
Yep.
Yeah. Thank you, everyone.
Thank you, Justin. Thanks for your insights. Appreciate them a lot. I'm sure we'll be getting some additional questions. Actually, we have time for the remaining ones, and then I'll go through with the demo. I think that's the best way. We have a question from George. How do the reporting obligations for federal issuers compare to those of state issues?
So the federal reporting requirements are monthly reports monthly public reports on the issuer's website that are certified by the CEO and CFO and attested to by auditors, and then also an annual audit for larger issuers. The OCC's proposed rule would also require weekly confidential reports to the OCC. State issuers this goes to the broader construct of the bill. The requirements directly are for the federal regime. The state issuers, the state regulators have some flexibility in creating their regime, but it has to be substantially similar. I think in this area where there's very specified requirements of like that monthly reporting requirement, the stablecoin certification review committee will probably say states have to do the same, like also have to have a monthly reporting requirement, but that will be like a floor, and states might require even more frequent reporting, but it will probably have to be at least monthly as well.
Perfect. Nicola is asking, how effective are the controls to be rolled out on the second market for MiCA? ESMA has raised the issue about surveillance of the secondary market and the ability to block the coins if illicit activity.
So Albert, I almost think that's a question for you, like how effective are the tools to monitor secondary market transactions? So maybe I'll leave that to you for your presentation.
Yeah, I think this will be very, very linked to what we're gonna demo shortly regarding blockchain analytics tools, how they function, etc. So let's leave that for later because we'll show it in practice. I think it'll answer definitely the questions in a much more clear way. Let's go to the next one by George here. I think it's a bit linked to what you talked about before. How can issuers ensure compliance with both federal and state risk management requirements?
So the first answer is you might not have to do both. So if you're federally regulated, you only have to take the federal pathway. If you are state regulated, I've been saying you're primarily regulated at the state pathway, so you would comply with the state's rules. There's a degree of backup authority for either the Federal Reserve or the OCC, which are federal regulators, even for state issuers. But that is meant to be in the case of special circumstances of something like really bad happening. Day-to-day risk management, it will be a matter of just as any regulated entity of complying with the rules, having a compliance department that is monitoring things, having ongoing dialogue with your regulator to ensure you comply with the rules. It's a bit hard to say today at the outset because all the rules are still being written and have not been finalized yet. But as they come online, all market participants are going to have to make sure that they create and stand up these compliance regimes to comply with these new requirements.
Thank you, Justin. We don't have a question, but we have some good feedback. So not a question from Chanel, but just to say, Justin, Merkle Science, this has been an excellent webinar. You've summarized what are otherwise very complex concepts in a clear way. Thank you so much for putting on this session. So yeah, thanks. Thanks a lot. And thanks, Justin, definitely mostly. Okay, there's 3 or 4 questions left. I think we can probably answer them in the end after the certification training. But for now, I'm just going to share my screen really quickly. And I'm going to walk all of you, not for too long, just a few minutes around what compliance looks like in the stablecoin space, what blockchain monitoring implies specifically. Let me just share my screen and then maybe you can confirm if you're able to see my screen. So this is what a standard, this is what a compliance system can look like. As you know, there's a lot of different providers and, there's a lot of valid options, a lot of valid possibilities for blockchain analytics, specifically about stablecoins as well. So this is in general a dashboard where you can monitor specific addresses, specific smart contracts in different blockchains, including stablecoins, which could be on Tron and Ethereum, etc. Right? So I just want to walk you through what that could look like. Here in the system, you can see number of alerts created that have been generated, number of alerts closed, risk level of alerts. What does risk level of alerts means? It basically refers to a set of rules that you will have implemented that are looking at exposure, both direct and indirect, in terms of funds or money that the specific address you're looking at could have received from illicit funds, such as sanctioned money, such as darknet markets, such as high risk exchanges, etc. So these are all things that you want to be looking at, that you want to be monitoring. And the risk policy will depend on your internal risk appetite, on your legislation, but also on the amount of alerts you want to have. Ideally, you want to reduce the false positives you'll be receiving as much as possible. So here you can see in this specific example, the risk level of alerts. Most of them are of the lowest risk. Then we have some that are critical, some that are high, some that are medium, etc. And here you can see the top rules that are triggered that I have implemented. In general, in Merkle Science, we provide what we call rule bundles, rule packages that are adapted to international regulatory bodies such as the FATF, referring to blacklisted countries, interaction with gray listed countries, transactions linked to high risk jurisdictions. All these different things, we've implemented them in our system so that you can readily install them and monitor all of these stablecoins that might be exposed to this kind of illicit actors, let's say. So the first thing to look at is we're going to look at an address, a specific stablecoin USDT, for example, so you can see what that looks like. So here we're going to just look for, if you look at the tab here, you can see dashboard, alerts, addresses, transactions, etc. So if you go to, for example, just about any address, let's look at, for example, this one in the Ethereum blockchain. What you will do is simply, you can paste it on the search bar, or you can also do it via API. Once you paste it on the search bar, you can go to a specific blockchain that you're interested in looking at. Here we have an Ethereum address, which holds USDC, it holds USDT, it holds Ethereum native tokens as well. So the first thing you see about this address is that it has a critical risk level, right? So that already tells us that this address has a serious exposure to illicit funds potentially. So how are we able to look at what we want to see here? So first of all, if you go to our rules, you see that we have had some rules trigger, right? One of the first rules, we've had several rules trigger depending on the ones you have installed, but the riskiest one is this FATF rule, which says indirect exposure to illicit entity, right? So this is one of the rules that has triggered the address to be tagged as critical. If you go more down, you will be able to see the entire risk exposure to this address. So this is the specific address holding the funds, holding the stable coins that we're looking at. And if you look, there's a lot of exposure, to crypto.com. There is some indirect exposure to Mexi Global, Coinbase, but there's also, indirect exposure via this private wallet and this private wallet, ultimately to this high-risk organization here, which is not a good sign. This is 1-2 hops away. This indirect exposure is still relevant with regards to the risk profile of our address when we're looking at it. And I think it's very important, to highlight the differentiation between direct and indirect exposure, especially from a compliance standpoint. Direct exposure would entail, funds being sent from our address directly to a service. This is just, for example, here, $580 of direct exposure that our address has sent to crypto.com, right? But you also want to be looking at indirect exposure, not to a full unlimited extent of indirect exposure hops, because that would just generate constant alerts. But definitely you want to be looking at somewhere between 5 to 10 hops away of interactions between your address and illicit services that might have been involved in transactions. For example, here, our address sends some money to this specific private wallet, $60,000, but then this private wallet sends some money to a high-risk organization, right? So we want to be aware of these indirect links. This is indirect exposure with one hop as an intermediary there. But in general, you want to be aware of these kind of things as well, right? So that's something we're able to look at with our blockchain analytics tools. And if you want to look at the specific role, which is this one, you can click on it. You can see this address has indirectly sent payments to a high-risk organization, and it clearly filters all the noise and just really shows you the specific link to the actual risky actor here, right? So what do you do from there? Essentially, this will send the signal as well to your system via API, via webhooks, so that you know that you might not, for example, want to allow this stablecoin payment to go through, right? We send you the response in less than a second, less than 300 milliseconds, so that in real time you're able to prevent the processing of a specific payment, a specific transaction, etc. So this is very, very important, right? And of course, for this to work, the most important thing is that you set up the rules appropriately as well. As I already said, if you go to our settings here, to risk management, you'll be able to see that we have a lot of rule bundles that we have included, that we have done with our team, studying the requirements, for example, of the FATF. And if you look at the rule list, you'll be able to see, rules that are being drawn directly from the recommendations. For example, FATF rule 11.3.2, transactions linked to high-risk jurisdictions. So if this address is owned by an actor considered a high-risk jurisdiction, then we're going to deem that transaction or that address is critical, right? So there's a lot of different rules here that are very, very helpful, obviously, from a compliance standpoint. But obviously, we also allow the customization of any rules of your own that you might want to include as part of your risk appetite, right? And we're more than willing to, essentially include any rules that you need, right? So this kind of things are very, very important, right? Now, like Justin said as well before, it's not only about blockchain analytics, it's not only about on-chain monitoring, but there's a lot more things involved in compliance, even if we're speaking specifically about stablecoins. That includes not only the actual blockchain analytics, but it includes things like being able to generate, STR reports, address reports that you could send to the, relevant FIUs. So, in this case, you can download a report about this address, generate a report, and you will have it here downloaded, and you'll be able to open the report as a PDF where you can essentially, look at this specific report, which will talk about, for example, I think you can see it here, but, you can basically look at the address report with the address, the blockchain it's in, the risk level, the incoming funds, the outgoing funds, the counterparties it's interacted with, and of course, the rules that have been triggered is also very important. And ultimately, what we call the audit log, which is essentially showing you which compliance officers have reviewed this address, the comments they've inputted, at what time these comments took place. These things are all very, very, very important. And also the possibility to have a case management system, right? I mean, to be able to escalate alerts, this kind of 4-eyed principle, at least very, very common in Europe, where you should have different lines of compliance, different, queues, the releaser queue, the approver queue, all these kind of things. You will need in a system to effectively escalate alerts and be able to have different set of eyes for an efficient compliance system. These are all things that we can help with, right? So it's not only about having pure API signals saying this is risky, this is not risky, but rather having an entire compliance system that you can utilize to effectively build an efficient compliance system. Right. So I think this is one of the most important things. And this is very, very focused on the transaction monitoring, the monitoring of stablecoins from the perspective of inputting specific addresses. Right. But we also want to speak a little bit about something a bit different, which is the helicopter holistic view of monitoring an ecosystem. And this looks a little bit different. That's what I wanted to show you. This, for example, the USDT token. Right. This is what we call an ecosystem dashboard, an intelligence dashboard, where we're not showing specific transactions. We're showing token health, supply dynamics, risk metrics surrounding a specific stablecoin. So here you can see USDT stablecoin, daily holders on average, transfer volume, total amount of transactions that have taken place, trends over time. These are things that we can do for specific tokens, for specific stablecoins that can really be of use for different actors, for exchanges, if they want to see the health dynamics of a specific token. For example, if we look at the risk part, maybe they want to see let's see clean flows, risky flows. Maybe they want to see how much money was sent to bridges, inflows by risky counterparties. Obviously, it takes some time to load because it's a lot of information. But basically, this is what we do. We essentially are building tokens and kind of we're analyzing the information on the tokens, and we're trying to derive data that can help to assess the riskiness of specific stable coins, right? So this is obviously very, very important. And we thought this was definitely worth showcasing. And this is something that we have available not only in what I will show you, but we have it available in a system which we call KYBB. I'm sure a lot of you are familiar with the concept of KYB, Know Your Business. We have a solution called Know Your Blockchain Business, where you can essentially look at VASPs and look at the entire, let's say, risk profile on-chain activity. And also you can look at tokens. So just like we're seeing USDT, we could look at, let's say, USDC, for example. And we can say, okay, so let's look at it, analytics. And here you will essentially be able to see, the overall activity on USDC about number of active addresses, token price tracker, and what kind of high risk counterparties are involved, what kind of sanctioned counterparties are involved. Obviously, you'll have to filter based on blockchains, and you'll have to filter based on time period, and it will take some time to load. But this kind of solution basically gives you access to these different types of tokens, so that you can actually see and do your due diligence, let's say, on the amount of ecosystem activity that is going on there, right? So hopefully, if you're interested in seeing some more of this, would be more than happy to walk you through it as well, or whether it's this or the actual wallet screening, transaction monitoring, more than happy to sync with you all. And please feel free to sync with Justin as well if you have some additional questions. But I think for now, that's actually most of the relevant things that we wanted to walk you through, because we also want to allow you, I'd say, like 5-10 minutes maybe to fill in some questions, so that you can consider this training complete and receive your certification. So let me just send you the link in the chat, and please let me know if you can access it as well. Just give me 1 second here. Okay. Let me know if you are able to see it in the chat. Okay. Hopefully you're able to access it, or you click on it at least.
I see it.
Perfect. So yeah, you can just click on get started, and just fill in the questions, and then you'll receive a certification for attending this webinar. If you paid enough attention, which I'm sure you have. Definitely no hard feelings there. But I think in the meantime, as everybody is filling these questions in, maybe we can answer a few more that were already in the chat. And I think most of them are directed to Justin anyhow. But let's have a look here. So we have one from Maria. If you don't mind, Justin, answering a few more. I think you've already answered 24 questions, so really much respect for you. But we have a few more here. So from Maria, are all policies, report templates, and other internal documents of a crypto company required to be drawn up independently, or is it anticipated that the relevant templates for the entire necessary set of documents will be developed at a federal level?
No, issuers will have to develop their own internal policies and procedures. They'll be guided by the requirements and the rules, but they will have to create their own.
Okay. Another question from Anna. Is my understanding correct that share will be covered by the legislation yet to come and not Clarity Act? Could you touch upon these shares issuers?
I'm not sure what D share is referring to. If the question is just asking about tokens other than payment stablecoins, yes, that will be covered by market structure like the Clarity Act.
Perfect. Yeah, I think we would need a bit more clarification on the D-share aspect, but yeah, if you want to redraft the question, then yeah, we'll be more than happy to help you. We have one from Yodia. How do you see the stablecoin pegged by the USD outside the US, specifically in the EU?
Even if it's a payment stablecoin and the issuer is a permitted payment stablecoin issuer regulated under Genius, Genius doesn't directly address the trading on EU platforms. It will be a bit of an interplay because the stablecoin itself will be the issuer will be subject to the US requirement for the reserves, for the various reporting requirements and such. But the actual trading of the coin in the EU would be subject to MiCA and the EU rules, not US requirements.
Perfect. Maria's asking, can I be registered as an online platform in a particular state obtain all the necessary approvals and licenses in that state, but operate across the whole of the US without obtaining a federal license?
The short answer is yes, probably. I would say preemption for states across to other states, there remains some uncertainties. And I would say the Genius Act itself, the preemption provisions are a bit less strong for state issuers. I think there's clear federal preemption for federally regulated issuers. But for state issuers, there's an intent in the bill to say that if you are registered in a state and that state has been certified as substantially similar, that you would not have to obtain licenses in other states, subject to two kind of exceptions. One is for consumer protection requirements, and then two, there's a separate provision in the act that says for money transmission activities in other states, you could only do it if your home state, so the state that you are registered in, has capital and liquidity requirements that meet certain standards. But generally, the intent is yes. I would say the full scope of preemption is a little unsettled on state to state, but the act does provide for it.
Okay, we have a clarification from Anna with regards to the question before about D shares. So apologies. To clarify, D shares are tokenized public market securities. These shares are tokenized public market securities that are one backed by a security, commonly equity. They provide investors with exposure to real world securities while offering the liquidity and flexibility of decentralized finance. Additionally, yeah, so I think you can take it from here.
And the question was, how does the Clarity Act address tokenized securities, I think?
Yeah.
So the Clarity Act is primarily focused with like digital asset native tokens, but it does address tokenized securities in a few places. Generally, it says, which is consistent with what the SEC has said, that they are still securities, even if on a blockchain, subject to securities law requirements. By virtue of the Clarity Act creating these new registration categories for digital asset focused intermediaries, that will inherently address how those digital asset entities are facilitating transactions in tokenized securities. But I wouldn't say the focus of the act is on tokenized securities as much as it is on things like more like Bitcoin and Solana. The SEC itself has been issuing guidance on tokenized securities in the meantime. Clarifying the point that yes, these are still securities subject to securities requirements. The SEC staff has also recently issued an interpretation that categorizes different types of tokenized securities, because there's different tokenization models. So like a natively tokenized security versus a wrapped token. And there's different types of wrapping structures. The most noteworthy thing is certain wrapped structures look like a security-based swap, which is subject to additional regulatory requirements under the Dodd-Frank Act for swaps and derivatives.
Perfect. We have one more question, but I just want to come back to something because it seems like there was something not loading, or at least it took some time to load because it's a lot of data, but I do want to make sure we can show it because I think it's very, very interesting with regards to this webinar about, stable coins, ecosystem safety, risk prevention, tactics for stablecoin monitoring, etc. So here you can see the ecosystem dashboard for the USDC. And here you can basically see a lot of relevant information, right? Once the data loads, sorry about that it took so long, but it's a lot of data. So you can see USDC, number of active addresses, token price tracker, number of token transactions by blockchain. Here you can really see the different ones, market capitalization by blockchain, daily transaction count and volume, token holders by service name, who are the biggest token holders, how much balance is there, what's the number of holders within that service, what's the actual percentage, top token holders by address. Okay, this is also very, very interesting. And then if we get onto the actual more illicit activity side, also very interesting. We can go to the involving high risk counterparties tab, and you can see 128 million transactions involving high risk entities in the USDC space. 22 you can see it here. Amount of USD sent from high risk entities, 1.17% of funds sent from high risk entities. You can see the biggest categories that were involved in the USDC token space. So you can see that 92% was gambling, 6% theft. And you can see the high risk entity names as well. So this is all very, very interesting. And then finally, you can see sanctioned counterparties, number of transactions involving sanctioned entities, main blockchains, etc. Right? And you can see the specific entity information and specific addresses. These are all things that we can and are able to do upon request. And these are all things that can be very, very relevant for specific use cases, for specific governments, for specific central banks, for specific exchanges. They're all very, very valid use cases. Right? We have one last question from Gerard for you, Justin. Will disclosure reporting beyond just reserve KYC, AML, etc. be clarified, and will it be similar to reporting requirements for other asset types?
So yes, I expect all the reporting requirements will be further clarified in the implementing rules. Will they be similar to other assets? I guess it depends on which reporting we're talking about. I think reporting on the reserves will be pretty specific to stablecoins. I laid out what the OCC's proposal is. Other regulators have not yet issued their rules, but I imagine will be similar. In terms of transaction reporting and suspicious activity reports, those rules haven't yet been issued, but I would expect them to be similar to the types of illicit finance reporting done for other asset types. Obviously, it will be a bit nuanced and have blockchain-specific information, but I think generally there will be similarities.
Okay, I think that pretty much sums it up with regards to all the questions, and I think it sums it up from our side as well. We hope that you really enjoyed this webinar, and we hope you had time to fill in the questions and that you could get your certification training on navigating the Genius Act here with Justin, that has very kindly answered a lot of questions today. So thank you very much, Justin, and thanks everyone for attending the webinar. So yeah, I don't know if Justin, you want to say something there.
No, thanks everyone. As I mentioned before, the slides should be shared afterwards. I hope they're helpful. Obviously, there's a lot to unpack with the Genius Act, and we're just in the midst of it with all the rules. But thanks for inviting me, Alvaro, and very nice to meet people electronically, at least, and answer your questions. So have a great day.
Thanks, everybody. Have an amazing day. And yeah, currently I am in beautiful Cannes in France for the Ethereum event. So if any of you are around here, feel free to reach out to me privately. I'll be happy to catch up with you. But yeah, for the rest, thank you very much. We look forward to seeing you in future webinars. Thank you, Justin, and have a great day, everybody.